anybody who does like an hour of research into like the truth about nuclear energy realizes, oh my gosh, like this is insane. And so much so that I think that there's probably a behind the scenes effort from like oil over the last like 40 years because nuclear is the only thing that can really displace it. And a big behind the scenes push to try and get it shut down. But they're actually changing, and so politically, we're seeing a move. They're starting to subsidize it or move to subsidize it. We're seeing sentiment shift from individuals just over the last couple of years. Favorability towards nuclear energy has shifted from like 50% up to above 70% just in the last couple of years, and that's both Democrats and Republicans. So we're seeing a big shift take place as people learn the reality, learn the facts, and the fact that it's necessary. I think all those things. I'm very bullish on uranium.
Hello and welcome back to Capital Cosm. Today I have a special returning guest on the show. It is Mr. Joe Brown. Joe, thanks for coming on.
Hey, thank you for having me again.
Thanks for coming back on, actually. Yeah. Happy to have you back. So before we get started, though, neither Joe nor I are financial advisors, so please do your own due diligence. With that said, Joe, for those who may have not seen our first interview, give us a really brief rundown, intro on who you are.
Yeah, absolutely. So I'm not a financial advisor anymore, I should say. So back when my wife and I got married, we were broke, tons of debt, no way to pay it off. I was making below minimum wage at the time. And so I was like, man, I got to figure out a way to get out of this financial hole. So I stumbled across Dave Ramsey, learned about his whole debt snowball and that system, and really kind of sparked some curiosity in me. And I started reading about investing and trying to learn about that. And I had a buddy at the time who was a stockbroker. And so I was talking to him, trying to learn from him. And he was like, hey, look, if you really like this stuff, he's like, I could probably get you a job in our broker training program. So I was like, all right, I'm in, let's do it. So he kind of walked me through what the interview process would be like, helped me, get in the door there. And I just ate it up. I loved it. Once I became a broker, I did as many different things, as many different jobs as I could to try and learn how things worked from the inside out. Worked in trading and sales, and ultimately, after about 5 years, I had gone through this process of number one, pretty much absorbing and learning everything I could from the inside, and it got to the point where I started. I was very interested in macroeconomics and how things like how the whole system works together. So I remember specifically talking with certain people that at the time I thought, I was like, man, these guys have all the answers. They know how this stuff works. Talking about things like interest rates and where inflation comes from. And there's just no, at least at the time, there was no attention being paid to that. It's, that kind of stuff is irrelevant. And the answers that, are given are just kind of meaningless. Attributing things to, things without definitions like animal spirits, basically. So I started doing a bunch of research and basically just reading books about how it worked, and stumbled across Austrian economics. Found people like Peter Schiff. Ultimately, it just got to a point where I realized, the stuff that I'm selling, I don't really believe in anymore. And I wanted to educate people about how the system really worked. So in June of 2019 is when I quit and started Heresy Financial with that in mind. And I did a couple things, but my YouTube channel kind of took off first. So right at the beginning of 2020 is when I kind of went all in on making YouTube videos. Turned out to be good timing. Obviously, we all know what started in 2020, but the rest is history. So I've been educating people on YouTube and training people how to invest from that through my university, Heresy Financial University.
Yeah. And I've actually watched your meteoric rise from 2020 up until today, actually, back when before you had any cuts to your videos. It was just all one stream of consciousness. It was great. I learned quite a bit from those
Well, thank
days.
you.
Yeah.
Thank you.
Yeah. Um, so I want to kind of take it to the, some of the stuff that's happening in the markets right now. We're about to hit all-time highs for some reason in the S&P and the Nasdaq, et cetera. Why are we about to hit all-time highs? I thought we were entering a recession soon. What do you think?
Yeah, there's a couple of reasons. One reason is I would say over the last month, we've seen a huge shift in big money to buying equities. Part of this comes down to the fact that for the Federal Reserve has done has continued to say, in advance, hey, we're planning on doing this, we're planning on doing this. But when something changes, those future plans are no longer relevant. And so we saw that early on when they said we're not even thinking about raising rates. So all the banks loaded up on treasuries because everybody's like, these things are going to stay their current value because the Fed's not raising rates. And then suddenly when inflation, when the Fed realized inflation was sticking around, bam, they started raising rates at the fastest pace in history and basically made every bank insolvent. And they had to, institute the new round of bailouts for banks, starting with Silicon Valley. And so there's that. And then now what we're seeing is kind of the opposite, where the Federal Reserve was positioning, hey, we're going to continue to raise rates. And then it became kind of clear over the last couple of meetings rates might not actually be going up anymore. And so the stock market over the last year has been going up and up and up and up. And big money is, managers have not had their clients' money invested in equities. And so there's kind of this scramble to get positioned into equities so that they can show, hey, yeah, we actually, we're not sitting on the sidelines in cash watching the market just run us by. Part of the issue with that is it's going to be a giant rug pull because valuations don't support it. The economic conditions don't support it. When you have rates get lowered by the Federal Reserve every single time since 1950, that has resulted in a recession other than two of those times. So out of the last, it's about 20 times that the Federal Reserve has lowered rates since 1950, and two of those have not resulted in a recession, but every single other time has. And so you do not have the macroeconomic conditions supporting a continuing booming economy. You don't have valuations and equities continue to support that. So we're getting this big rally sparked by big money throwing everything in, pushing equities up. Retail starting to pile in now, buying at the very, very top, and they're going to be left holding the bag. So they're going to be buying as big money exits right after the turn of the year. That's my expectation anyway. And so there are a bunch of other indicators that support that, but it looks like kind of a classic pump and dump. Even though it's not a penny stock, it's major stock markets. I wouldn't anticipate this rally to extend much further past the first of the year.
Yeah, fascinating. Could it also be that inflation is simply underreported and the real rate of inflation is actually higher than the 550 some odd basis points that the Fed has raised over the last couple of years?
Yeah, so the likelihood that the real rate of inflation is the same as the reported or official rate of inflation, it's a very low likelihood. However, what that also means is that there are certain time periods where it's very possible that the real rate of inflation is actually lower because of the way that they calculate this. And so when you look at third-party metrics, like there's one Shadow Stats. Yeah, so they take a look at, okay, if we measured inflation the same way as we did in 1980, here's what it would be. The problem with that is consumer behavior is nothing like it was in 1980. I mean, we have cell phones today. We don't buy radios anymore. And so there are things and ways that you used to measure, like there's justification for change in the way that you measure inflation over time. I just think that the CPI tends to abuse that justification, go way too far. There are other third-party stats, though, like one is called Truflation that shows the real rate of inflation is a little bit lower than what the CPI is right now. During, like a year and a half ago, it was showing way higher than what the CPI was showing. So I would probably not say right now, at least, that the real rate of inflation is much higher than what the CPI is showing. But at the end of the day, it's actually impossible to know because when beef gets more expensive, people will buy more chicken, and that
Yep.
behavior change alone stops the price increases in beef. And so the behavioral changes cause the price changes that then cause behavioral changes. So it's not even something that's really possible to measure accurately. And so we don't have I'm not putting a lot of my eggs in the inflation basket because it's so subjective. Every single family is different, every single lifestyle is different, every single good in different locations is different. So it's when something is that impossible to measure, um it's really hard to say one way or the other.
Kind of meaningless in a way. Um, what you kind of alluded to there is substitution. There's another thing
Mhm.
called hedonic adjustments, which is basically, if you've got if you got a cell phone and you can increase its memory by 2x, but you only charge 1.5x more for the actual price of the cell phone, they consider that a price cut or a deflationary event, right? You also alluded to some of the things that the CPI does in calculating inflation are justified. What are some of those things?
Well, part of that, like that process that you just described, is actually justified. For instance, like the cell phone that we have today, let's say it costs you $1,000 to buy a new cell phone. That takes the place of thousands of dollars worth of equipment that you'd have to buy to get
Right.
a fraction of the abilities 20, 30 years ago.
Just having the
Um,
Uber app, for example, is a
yeah,
huge deflationary.
the Uber, yeah, exactly. The Uber app, just maps in general. You don't have to buy atlases anymore. You get maps for free. Not only that, but this is an example of like capital goods. There are certain capital goods that are like consumer capital goods, and there are certain capital goods that are like assets. So one of them you consume for your own benefit, like a computer. You can watch Netflix on it, but with the same computer, you can also generate income. And so the same thing can be used for two different purposes: one for consumption, one for production. And the just the straight up ability to produce a lot more today based on just what we can do, like with the internet and video based social media platforms, and the income that is able to be produced today that didn't exist even 10 years ago, is insane. And so you have to in some way try to take that into account when you're measuring the broad level of prices.
Yeah. So, in classical terms, inflation used to be referred to as money growth, right?
Yeah.
And so, I want to share this chart with you. I saw one of your videos. I think you posted it today or yesterday, and you basically kind of showed this chart here from long-term
Yeah.
trends. And what you've basically got is M2 money growth, year over year growth in black, and then you've got the CPI here in red. And if you look all the way back to the 1870s, for example, we haven't had a year over year decline in money growth since what is it? 1933. So yeah, Great Depression.
Right. Yeah.
So
Yeah.
is that
And
what
look
you're
what it
alluding to there?
started to. It was 1931. Yeah. Yeah.
Yeah.
Yeah, exactly. So, you bring up a good point. Number one, that's what the word inflation and deflation meant classically. So if you look up into the dictionary from 100 years ago, that's what it referred to, was whether the money supply itself is increasing or decreasing. And that is a much easier thing to measure. It's still not 100% black and white. Because if you print a pallet of money and ship it off to Mars, it's like, well, you didn't actually increase the money supply. What if you put it in a vault that nobody can access? Well, no, you probably didn't increase the money supply that way either. What if you put it in a vault that you can access, once a month? Well, maybe, but did anybody actually access it? Okay, well, what if you keep it in a checking account that somebody can access whenever they want, but nobody's currently accessing it? So, like, where do you draw that line? And so there's some it is a gray area, but it's very commonly accepted that M2 is one of the best ways to measure the money supply. It's like checking accounts, savings accounts, and money market funds. It's like basically if something can be accessed readily as cash, it's going to be counted in the M2 money supply. And so I think that's a much better way to look at things, a much better indicator to look at, because it's very easy to have more of an objective way to measure that versus the general level of prices, which are much harder to measure. But ultimately, I'm not going to fight a battle of changing definitions that haven't existed for over 100 years. So when we look at a chart like this, yeah, we can see that normally in the United States, the amount of money that there is increases over time. And prior to the 30s, it was fairly frequent actually that you got a little bit of a dip in the money supply. If you see there were, usually there was a big spike in the money supply, and then it would be followed by a dip in the money supply. Yep. And every single time that was associated with a recession, a depression. If you look at those times, like banking panics, usually it was, there was a civil war, World War I. You have inflation, episodes of price inflation and price deflation. So all sorts of economic problems are associated with that. And this is the first time we've seen the money supply drop since the 1930s. It actually doesn't matter that it's following a big increase in the money supply, because that's normally what happened in the past when you still get those economic problems.
Yeah, I mean, you look at this red line here and you have 1, 2, 3, 4, I mean, maybe 5 too. And all these episodes of inflationary spikes all occurring within the span of less than 100 years. And so it's just really interesting how tame it's been over the course of, since Bretton Woods, let's say. Now, I want to kind of connect this with the real estate market. There's one of my buddies, Andy from Finding Value Finance. He was able to do some work and kind of figure out that, these booms and bust cycles are very tightly tied in with the real estate market. So, because it's a credit creating event, right? And it's also a credit destroying event when it's on the downside. So when you look at real estate, you have housing starts over the course of, let's say, 2009, well below what would be their average. Now, we don't have like a clear average here, but I believe I believe Andy said when you kind of crunch the numbers, you'd get around 1.5 million housing starts as your average, but we've been well below that. So from a housing supply side of things, we're actually well below where we need to be to service a cohort like the millennials, which is a huge cohort coming into home buying years. If real estate, can we have a huge economic contraction without the real estate bubble popping? Or do you think that real estate is in a bubble and will follow that trajectory?
Yeah, great question. Okay, so there's a bunch of things wrapped up in that. So let's start off by looking at this chart. So this is new housing units that are started. So as we can see here, that dip from like 2007 until about 2018, that's basically like a 10-year period where construction, new housing starts were way below historical norms. And so we had like and to be honest, it did follow a spike. Like when you look at like 2004 through 2007, they were, building more than necessary. And that's one of the big things that contributed to the housing crisis. I mean, I remember people close to me having 3 rental properties, and by the start of everything, starting to collapse, they were all empty. Good luck finding an empty rental property today. They don't exist. And that's the reason why rental prices are increasing, even though house prices and interest rates are together the most unaffordable housing market in history. If it was the same as the Great Financial Crisis, rents would have been dropping because there'd be a bunch of empty housing units. But we had a lost decade where there wasn't the construction necessary to keep up with population. Now, the other thing is, it's not just about population, because the population growth outside of 2020 and 2021 has stayed consistent. Since the 1970s, Americans do not have enough babies to replace our population level since the 1970s. But our population has continued to grow at about the same pace that entire time because of one thing: immigration. That obviously stopped during 2020 and a little bit into 2021 because a lot of global movement was forced to stop. but that has picked back up again. And so on average, when you look at the last 10 to 20 years, we have a lot more people that need a place to live. And we had about a 10-year period where they weren't building the places for those people to live. That's why so many people are living with their parents today, because they can't afford to buy a place based on the price versus average incomes. And there's a lot of other things associated with that trend as well, but that is a big contributing factor. There is another trend or factor that is not normally looked at, and that is the fact that today the number of people who live in each housing unit is way lower than it used to be. Back in like the 40s, the average number of people per housing unit was like 4 or 5. Today, the average number of people per housing unit is like 1 or 2. Even the large houses that are being built, like per square foot, they still only have 3 bedrooms, sometimes maybe 4 bedrooms. And all of the apartments, all of the small living arrangements, they're not built for many people to live. And if you look at the trend, it's just continued to trend down and down and down and down. Fewer people are living in the same housing unit. So we have this trend of less units are being built, more people are needing those units, and there's less units per number of people there's less people living in each unit that gets built. And so all of those together mean there is way more demand for the places that there are to live than there are places to live. Now, the second thing you asked was about how is it possible for an economic contraction to cause a big pullback in real estate prices? Absolutely, it is possible. If you get conditions where a lot of people, like a big percent of the population, can no longer afford their housing payments, then they default. They move in together. Yes, there's only 2 bedrooms, but now you have 4 people living per 2 bedrooms, or 2 or 3 people living in each bedroom. Like you have Great Depression type of stuff happen. Absolutely, you will have prices come down because people will be forced to consolidate living together and just have much worse living conditions. That's absolutely possible. My guess is that before things get that bad, we would probably see the Federal Reserve lower interest rates significantly. We would probably see something like quantitative easing restart, which would just fan the fuel again underneath the fire of real estate. Real estate moves very, very slowly. So by the time you get to that point, everything else would have gotten so bad that they would have the justification to start printing money again. And then the final thing that you mentioned, or I don't know if it was the last thing, but you did mention this, was is housing actually a bubble? And you can't just look at price today compared to price in the past and determine whether that means it's in a bubble or not. You have to take into account all factors. And typically, when something is a bubble and it's about to pop, you see one thing every single time, and that is euphoria. Look at NFTs right before the pop. Look at the meme stocks. Look at even Bitcoin. Look at gold stocks in like 2011. Every single time you have a bubble, even real estate, right before the financial crisis started, there was euphoria. Everybody who were unsophisticated investors thought this is my path to becoming rich quick. Euphoria is always present when there's a bubble, especially right before the bubble is about to pop. More people today than ever in history say that it is a bad time to buy real estate. It is literally the opposite of euphoria. I've never seen a bubble form on desperation. Bubbles form on euphoria. And so for all of those reasons combined, I don't think we are going to have any significant correction, crash, downturn in real estate. Fundamentals just don't support it unless the Federal Reserve just says we're going to make things extremely, extremely painful.
Yeah. So you mentioned that rate cuts. We'll see rate cuts followed by, everything kind of following the rate cuts down. A lot of people are kind of giddy over the fact that the Fed might cut rates in 2024. Is that really anything to celebrate? Because historically, it's actually quite the opposite. When the Fed cuts rates, it's usually when things go down the tubes, right?
Yeah, exactly. Yeah, that's not something that um, that typically brings in good times. When you look at the Federal Reserve's history of lowering rates, we could even pull up on the Federal Reserve's website the
Yeah,
chart of the Fed funds rate,
I'm trying to
because
look for it
that's
now,
the
actually.
on their website search Fed funds effective rate. Um, and you'll what we'll notice is that every time that interest rate gets lowered, it's either right before or right during a recession. Um,
Yeah, so this is something I posted a while back. This is what I was looking for. It's basically highlighting your point here is the anytime the Fed cuts rates, which is denoted by this blue line here at the bottom, you've got the S&P here at the top. Anytime you cut rates, you have a 50% drawdown here in the early
mhm.
2000s, 58% drawdown in 2008, Fed pivot here as well in 2020 minus
Yeah.
35%. Is this what you were kind of alluding to?
Yeah, so that's the impact on markets. And obviously there are certain times when the markets move down when interest rates have not been cut. But when you look at when they cut interest rates, that does have a
Mm,
negative effect on markets. But it's also beyond that, it's the effect on the rest of the economy as well. It's recession as well. So it's not something to look forward to in terms of, hey, this is going to make things, return to good times of, end of 2020 and 2021 when everybody felt like they were becoming extremely wealthy. It's not going to be like that. And even if it is, if you look back on that, very few people actually did get wealthy. It was all a false wealth effect that evaporated and did not result in the type of life changing wealth building that a lot of people thought it was.
yeah, yeah. So in addition to that, we also had over the last year, let's call it the 2023 wrap up. We had the 10-year go above 5%. Did it go above 5%, or was this kind of like teasing 5%? I can't remember exactly.
It I believe for like 2 days
Yeah.
it did go above 5%, but it didn't stay there long.
Yeah. And now it's below 4%. What does
Mhm.
all that mean exactly?
Well, that's partly due to the expectation that the Federal Reserve is going to be cutting rates. And so when you even just from a free market perspective, if you see prices like the rate of inflation coming down, or if you see prices coming down, then you're looking at your dollar and you're thinking, okay, if I need to get a positive return on this dollar over the next 6 months, or let's say the next year, I need a 6% return on this dollar to net a real 3% because my purchasing power is getting eroded by 3%. But prices are falling. Economically, things are not looking that hot. And so in the next, let's say 3, 4, 5 years, there's actually a good chance that prices actually fall during that time, at least briefly. And so if I'm expecting that, I don't need a 6% return on my dollar for the next 10 years to have a positive return. I only need maybe a 4% return on my dollar for the next 10 years to have a decent positive return because I'm anticipating then that maybe the real rate of inflation during that time will bring my positive I'm sorry, the rate of inflation during that time will bring my real return down to again 3%. And so that's why we're seeing interest rates at the short end of the curve, like T-bills right now, are still 5.5%, whereas the 10 years at like 4%. That's an extremely inverted yield curve. That may also be the reason why the Federal Reserve is looking to potentially lower the Fed funds rate going into next year, or especially like 2025, because in order to restore solvency to banks' balance sheets, they will need to kind of help um, normalize the yield curve. And if they lower interest rates, that's the Fed funds rate that gets lowered. That's short-term rates. That allows the federal government to borrow cheaper at the short end, which means that they'll have extra spending power, which is bringing new money into existence, which increases inflation, which means nobody's going to lend to the government at 4% anymore. They're going to lend at 5, maybe 6%. And so having that, that's why when the yield curve uninverts, that's typically a sign that the recession is, imminent, because that's the effect that's taken place. So the interest rate inversion of the yield curve right now is showing just expectations of future pricing. And when the Fed then pushes down on that lever, we should expect the yield curve to uninvert, inflation to get reignited, and interest rates for everybody else actually, ironically, to go up.
Right, right. So, I mean, we're closing out 2023 in the next couple of weeks or so. What do you see ahead for 2024?
I think so. For the first couple of months of 2024, we'll probably see some very similar things that we've seen over the last couple of months. Not much to change. Maybe a swift correction in the stock market, but economically speaking, not much else. We're going to see a full drain of the reverse repo facility at the Fed. And that's just simply, we don't need to get into the mechanics, but there's some excess liquidity that was left over from all of the printing that took place in 2020 and 2021. That's currently in the reverse repo facility. As the government borrows right now, they're slowly pulling money out of that facility. That's reintroducing that cash back into the banking system. So when we look at the money supply over the last 6 months, that's the time frame that money's been getting pulled back in. We've got about, maybe till February until that's gone, which means that the money supply will start to drop again from there. So I would anticipate once that is empty, then we'll start to see that it'll just be like a countdown timer to liquidity issues. When are we going to see issues with the government trying to borrow money and there's not enough cash there being lent to them? When are we going to see the Federal Reserve talk about their plan to lower interest rates? When are we going to see talk about the Federal Reserve stopping quantitative tightening? And so I would not be surprised if all those things happen at some point during 2024, which will result in a reigniting inflation.
So are you bullish on commodities for 2024?
Yeah. The funny thing is, like, gold specifically, and I put Bitcoin in that camp too, tend to sniff these things out a little bit ahead of time. Gold a little bit more so. Bitcoin is more closely correlated to current liquidity, whereas gold tends to sniff those things out ahead of time. So that's why you saw the gold price rally 40% from 2020 to the peak in 2021. And that was ahead of any inflation. And once the inflation actually hit, it had already made its move. Everybody had already bought it. Everybody was already protected. They got their advanced protection. And so I would anticipate that once the market starts to sniff out that future inflation coming, gold is going to start to skyrocket again. The other commodities tend to follow a little bit after. Now, in terms of something like, I don't know, like energy, oil has been actually performing pretty well over the last couple of weeks. Uranium over the last 6 months or so. So I'm still bullish on energy as well. I think all these things geopolitically that are going on are bullish for energy prices. And so to protect yourselves from, like, hey, gas prices are going up or my electric bill is going up. A lot of utility companies, they're adding on fees. Like, you're not using more electricity, but they're charging you more. You can offset that by investing in energy. And I would actually say that's pretty true of most things. If you're wanting to offset the negative effects of price inflation, be an investor in those things, and then you reap the rewards of it as well.
Anyone in particular that you're more bullish on than the others? What about like something like natural gas or coal, who taken quite a beating over the last year?
Yeah.
I don't know if you've seen. I'm sure you've seen the natural gas chart where we just like spiked all the way up to $12, and we're back down at $2, $2.50.
Mm-hmm. Yeah, go for the next year. I mean, for things like energy, that's a little bit of a short time frame. I'm probably most bullish on uranium. Out of most other yeah, I would probably
That's
say
what my
uranium
listeners want to
is.
hear.
Oh yeah.
Yeah, they're big uranium bulls here on this channel.
Well, I mean, it makes sense. The geopolitical uh structure is, I mean, most uranium right now comes out of Russia. Thank Clintons for that. The American and Western production of uranium is like, it was just demolished. And so that's changing. They want to try and source uranium locally. It just takes a long time to get there. There's currently way more uranium being consumed than there is being produced. Um, Uranium is, obviously it fuels nuclear power production, and that is the only form of energy production that is both dense enough, clean enough, and safe enough. And has the scaling capacity to produce the energy that the world needs going forward for decades. There is no, on all of those metrics, no other energy production comes close. And if you think it's not clean, if you think it's not green, if you think it's not safe, if you think it's not dense enough in terms of energy, it's like, like, the reality is you've gotten your facts about uranium or nuclear from The Simpsons. It's just not based in reality. Anybody who does like an hour of research into like the truth about nuclear energy realizes, oh my gosh, like this is insane. And so much so that I think that there's probably a behind the scenes effort from like oil over the last like 40 years, because nuclear is the only thing that can really displace it. And a big behind the scenes push to try and get it shut down. But the tide is actually changing. And so politically, we're seeing a move. They're starting to subsidize it or move to subsidize it. We're seeing sentiment shift from individuals just over the last couple of years. Favorability towards nuclear energy has shifted from like 50% up to above 70% just in the last couple of years. And that's both Democrats and Republicans. So we're seeing a big shift take place as people learn the reality, learn the facts, and the fact that it's necessary. I think all those things, I'm very bullish on uranium.
Yeah, and the fact that the fossil fuel industry could be behind some of this negative propaganda when it comes to uranium, that's very real. That's actually documented. You guys, I had an interview with Chris Kiefer the other day, and we talked about this stuff. The coal industry back in the 60s actually pushed the government to unsubsidize the nuclear power industry. This is back in the 60s, not the 80s, not the 90s, not this past decade, but all the way back before your nuclear power even had much of a foothold in the United States. So that's a very real proposition there.
And on top of that, look at the money that they pour into positioning themselves and posing as like, hey, we like wind and we like solar. Well, why would oil and gas companies like wind and solar? Because the
Intermittent.
wind is not always there
Yep.
and the sun's not always there. And what do you need when those unreliable sources of energy are not producing? You need to go back to fossil fuels.
Yep.
So yeah, it's something that I'm very excited to see, because I think the future holds a lot more nuclear than the past.
Yeah. To kind of take it back to my interview with Chris the other day, he just came back from COP28, and he saw a completely different mood this year versus, let's say, 2 years ago. There's been a huge sea change. There's even a pretty aggressive commitment for tripling nuclear adoption by 2050. He's a big proponent for nuclear energy, and even he thinks that's a little too aggressive. So the world is kind of getting in line when it comes to sobering up and realizing all this wind and solar just isn't going to cut it. There's got to be something foundational that can hold this stuff together. These are at best intermittent forms of energy. And
Mhm.
so, you can't really you can't really hold the energy that you gather from these sources, let's say from the summer to the wintertime. There just isn't enough battery capacity and so forth to actually do that. So I like the fact that you highlighted the importance of nuclear power there. I want to take it back to gold though. You
Sure.
mentioned that gold is the other yellow metal, right? Uh, you mentioned that gold kind of sniffs out inflation ahead of its time. It did so
Yeah.
back in early 2020. It made an all-time high before we started seeing CPI reads of 9% a year later. We're starting to see some movement and traction in gold now. It's been consistently above $2,000. A couple weeks ago, it even made an all-time high, although it has been acting kind of schizo lately. We did see a 2150 rise and we came back down, broke down below 2000, and now we're sitting at around the mid 2000 level. So, what's been going on with gold? Is gold getting ready for a big run up because it's anticipating what you're kind of describing here, or is it something else?
Yeah, I would say so. The if you look at the day-to-day movement in gold, most that's what most people do who are invested in gold, and that's why most people get discouraged. It's even those big moves, like the big 40% move that it made until August of 2021, that took a while for that move to happen. And it was consolidating for years before that. So these moves, they take a long time. Like technically speaking, you can look at it like, the bigger the move, the more like energy has to be, like a spring. You have to squeeze that spring and then release it. And so if it takes 2 years for that consolidation to take place, it's going to it's not going to be like, hey, we touched an all-time high in the middle of one trading day. It came back down. Therefore, it's all over. Like the manipulators won. It's like, no, that's not how it works. It's you have to see some big movements when we're dealing with these time frames. And touch, just a note on the manipulation. I know a lot of precious metals investors believe that 100% the gold market is controlled. And the reality is to the extent any market faces manipulation, the more upside potential it has when that manipulation inevitably breaks, and it is inevitable. So a couple places that we can look at as an illustration of this. Remember GameStop? The most heavily shorted stock there was, had over 100% of its outstanding shares shorted, which is not illegal. There's a very easy explanation for how that happens. What happened to it? It exploded. It went through the stratosphere because the only way to short something is to borrow it and then sell it. How do you close out that trade? You have to buy it back. So every one of those manipulative positions has to be eventually closed out. And when it's closed out, it's the opposite trade from before. And so I hope there's a lot of manipulation happening. What's another example of this? Tesla. I don't remember the exact years, 2018, I think. Most heavily shorted stock. What happened soon after? It, 10x, 20x or something. As all those shorts have to get closed out, as they face their losses, they get squeezed out. An example before that, gold. What was the price of gold from 1945 through 1971? $35 per ounce. Why is that? Because it was the most heavily controlled, manipulated market there ever has been. It was a peg, a price peg. And so what were they doing? Printing a lot more dollars. That means that price that was legally enforced was not the true value. Guess what happens? It breaks. That's why we left the gold standard, because everybody was redeeming their dollars for gold. And Fort Knox was 2 weeks away from getting drained of all its gold. So Nixon said, no, you guys can't have the gold that we promised you. We're going to keep it all. You can keep your paper dollars. That's what happened. And what did the price of gold do after that once it was released from the peg? It skyrocketed into the stratosphere until it reached what the true market value was. And so to the extent that anything does face manipulation, eventually that manipulation has to break and you realize the true market value. And if that's happening, it simply just gives you the ability to purchase more of it at a price that is by definition under its true value. And so I hope there's manipulation happening because it allows me to buy more gold until that manipulation breaks. But intraday spoofing, little things here and there, yes, those cause short-term price changes. In my opinion, those don't do anything to the long-term value being reflected in market prices. And so, yeah, I know there's stuff going on. I know that people just got arrested from Chase. I know that there's, shenanigans that take place. I understand there are derivatives markets, but at the end of the day, any manipulation eventually fails.
Yeah, because manipulating anything doesn't change the supply demand dynamics. You know, you manipulate something on the downside. What are you implicitly doing? You're disincentivizing production.
Right.
And it's the old adage, the cure for high prices is high prices, and the cure for low prices is low prices. But if you keep prices artificially low, production doesn't come online, and that causes shortages, scarcity, and by virtue of that, you get higher prices. The lower prices can't sustain themselves. So if there is a way to just magically set the price to whatever we wanted it to, and supply and demand would just fall to the wayside, at the behest of those prices, all of these fixed economies, centrally planned economies would still be with us today, the Soviet Union, etc. But that's not the case, because that's not the way humans operate. Humans, you've got 8 billion nodes on the planet, all seeking their own self-interest, and no committee, no cartel is going to be able to outmaneuver, outperform, outsmart, this huge 8 billion node neural net in the process. So, I totally agree there. What about the role that silver plays during a gold bull market? Silver's it's part precious metal, part industrial metal. Is it 50-50 split, or is it more of an industrial metal than it is a precious metal? Because it seems that way recently.
Yeah. Silver, I mean, just as a side note, that's an example of a metal that somebody attempted manipulation on the other side. The Hunt brothers tried to corner the silver market and tried to buy all the silver. And that's a manipulative action on the price of something, and it drove the price sky high. And ultimately, that manipulation failed. It bankrupted them, and the silver price came and crashed right back down. So over it's actually the past couple hundred years, the monetary value of silver has been on the decline. The reason why silver had monetary value in the past was because it operated as change for gold. Like coins operate as change for dollar bills today. That's what silver did for gold, because you used to be able to, 1 ounce of gold, you could carry it around and you could use gold coins. But as the world was on basically a complete gold standard where gold was money, because the quantity of gold can't really increase incredibly fast, the amount of goods and services, the total stock of wealth, increases faster. And that means that stuff gets cheaper over time, because you have, let's just say, for ease of example, the same amount of money, but more stuff. That means it takes less money to get the same amount of stuff, or even more stuff. And so as you have technological progress, you have the increase in the total stock of wealth in the global economy, then those things get cheaper. Becomes cheaper to produce. It becomes cheaper to consume. And so your 1 ounce gold coins become more and more and more valuable over time, which means you no longer want to walk around carrying a couple gold coins in your pocket. Those things then just get put in storage, in safe storage, so that you can store your value. And then for your day-to-day transactions, you're using less valuable metals like silver or copper or nickel. And so that was the role that silver played. But through the rise of banking, and especially central banking, the role of change for gold that silver played, that got replaced by paper. Because if you have a piece of paper that says I can turn this piece of paper in and get 1 ounce of gold, you can also have a piece of paper that says I can turn 20 of these pieces of paper in and get 1 ounce of gold, or I can turn 100 pieces of these paper in and get 1 ounce of gold. So a piece of paper can represent
Arbitrary. Yeah.
any quantity of gold that you want. It makes gold infinitely divisible. And so you no longer need the silver, a physical commodity, to take that role. And so for the last couple hundred years, we've kind of seen the monetary value of silver decline. Now, sometimes people plot that by looking at the gold to silver ratio. And the problem with that is you have to exclude the time periods where the gold to silver ratio is pegged by law, because there were long periods of time where that gold to silver ratio was a legal ratio. And it either drove the gold or the silver out of circulation because that legal peg was not reflective of the actual market value. And so you have to exclude that. And once those pegs broke, now you have a return to normalcy. So we've seen that monetary value of silver decline over time. And I would argue today, it's not exclusively industrial value, but it's definitely the vast majority of the value from silver comes from its industrial usefulness. There's obviously still some monetary value to it because people still buy it and sell it for its monetary value. But the amount of value that you could, say of its total market cap comes from that versus its use in electronics and medical equipment, solar panels, everything else is a lot smaller. And so today, the value of silver mostly comes from its industrial use.
Yeah. Yeah. Is it pretty much on the same level as copper, or is copper more of an industrial metal than silver is?
I think copper is probably 100% industrial. I don't know, other
Yeah.
than a few, odd collectors here that are collecting old pennies. I'm not sure there's much, use of copper for any monetary value.
Yeah. Okay. Well, we've covered a lot in this interview here, Joe. Is there anything you want to plug before we sign off? And is there anything you want to leave the audience with?
Yeah, I mean, I would say that in this space, it can tend to get a little not depressing, but you can develop a very pessimistic outlook of the world. And I would say that it's important to understand how the economy works, how the world works, and try and, as much as possible, see around the corner to what could potentially be coming, but not so that we can complain about the way things are, but just so that we can be prepared to, number one, protect ourselves and profit off of those changes. And so I always try and take the attitude of this was what it looks like, but I want to be prepared for anything. So I'm not going to bet the farm on gold going up, or bet the farm on Bitcoin going up, or bet the farm on treasuries going down, even though I think those things are going to happen. I'm not going to bet the farm on that, because if I'm wrong, then I lose everything. And so I'm going to invest in a way where even if I'm wrong, it doesn't matter. And I'll place very, very small bets on those things that I think will probably happen. That way, if I'm wrong, I lose a little bit. If I'm right, then that's significant in terms of its impact on the portfolio. If you use things like, options, like derivatives, to make those bets.
Do you
Um,
use TA at all to identify opportunities or value?
Absolutely. Yeah, 100%. So that's part of like looking at, hey, trying to look around the corner, what is about to come. And look, there's more ways that we can be wrong than there are ways that we can be right. And so that's why I always say, if your success at investing depends on you being right, then you'll always lose money in the long term. And so you have to learn how to, number one, have a core part of your portfolio that is invested in a few very uncorrelated assets that you don't touch. Number two, you have to learn how to hedge. Number three, you have to learn how to make many small asymmetric bets, so that if you are right about something, you can profit off of it, and if you're wrong, you lose a very small amount. The methods that you use to do that are valid. There's a million ways to make money. There's one way to not make money, and that's not managing your losses. And so So some people prefer fundamental analysis by taking a look at the financials of a company and buying, the Warren Buffett method, buying companies for the long term. Some people like technical analysis, trying to do a little bit of day trading. They're all valid ways of money, and people have made fortunes all sorts of different ways. As long as you have risk management in place and you never, ever, ever expose yourself to a large loss, that's the number one rule that the most successful investors throughout history have all had, is just don't lose a large amount of money. And so I talk about this on my YouTube channel, and I teach how to do it, how to implement it through Heresy Financial University, if anybody's interested in learning more.
Excellent. And do you want to plug your YouTube channel as well?
Yeah, Heresy Financial is the YouTube channel, and then
Okay.
my website,
Yeah. Sorry about
Heresy
that.
Financial University. Yeah.
Got it. Well, that's it for today, guys. If you enjoyed this content, be sure to leave us a like, subscribe if you haven't already done so. Comment down below. Let me know what you think. I'll comment too. So I'll reply to your comments, and we can have a little discussion back and forth as well. With that said, guys, I will see you in the next episode. Bye, y'all.